Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent FOMC, and we're going to be discussing the implications of it on financial markets, of course, including primarily we're going to talk about Bitcoin. And I know that people are going to have some questions about Bitcoin dominance, so we will also discuss that as well. So we just had the press conference a few hours ago, and they released a press release at 2 o'clock Eastern. And I mean, of course, they left the federal funds rate unchanged at 5.5%. So it's been that way for about 10 months now, I believe, because March, I think, was 8 months. So I think we're now at around that 10-month mark. I think the median number of months of pauses, of months in a pause, is about 8 before the Fed starts to cut. So we are definitely, longer than average in terms of how long the Fed has kept rates at, theoretically the terminal rate. Now, we do have a lot to discuss today, and I don't really know exactly what order I'm going to go through everything in, but I will try to cover everything. I am trying to do a better job of keeping some of the videos shorter. The last two videos were shorter. This one's just going to be longer. I can't really get through it any quicker. So the first thing to note here is that there has been a change, okay? While they're keeping rates at 5.5%, there has been a change, and you can find it down here. And it says, beginning in June, the committee will slow the pace of decline of its securities holdings by reducing the monthly redemption cap on Treasury securities from $60 billion to $25 billion. The committee will maintain the monthly redemption cap on agency debt and agency mortgage-backed securities at $35 billion and will reinvest any principal payments in excess of this cap into Treasury securities. The committee is strongly committed to returning inflation to its 2% objective. So the reason why this is important is because there's going to be a transition at some point from quantitative tightening to quantitative easing. This is not that transition, but it gives you an idea, I think, of what to expect when that transition actually occurs. Okay? Now, and we'll talk a little about that later, but they're not stopping QT, quantitative tightening. They're just slowing the pace of it. Now, in the short term, today, but I guess because we're on a new daily candle, it's technically yesterday according to the markets, right? Technically speaking, alts liked this news in the short term, okay? And why? Because remember, altcoins, and this is against Bitcoin, right? Alt USD pairs are absolutely irrelevant. And again, I don't really want to keep explaining that, but alt USD pairs are irrelevant. Alt Bitcoin pairs today liked that news, right? They were up 5%. Alt Bitcoin pairs were up 5%. Now, they're still below this capitulation over here from 0.45, but they're still had a good day. Now, once the pivot actually comes, where we transition from quantitative tightening to quantitative easing, then I think something like this could be more durable. In this case, I think people are getting excited, but for reasons, again, I'll explain later, I think this will ultimately resolve to the downside. And I think the process is going to potentially kick off about mid-May, but we'll see. I don't really have a strict timeline on it. I don't really care when it happens, but I do think it will happen. I think this is going to be short-lived. But this is what would likely happen in a durable sense if it was actually a pivot from quantitative tightening to quantitative easing. Right now, the markets are just celebrating. Hey, they're not reducing the size of the balance sheet as quickly anymore starting in June. Let's celebrate. Okay? And if you're not familiar with what I'm talking about, if you go over here and we just look up total assets held by the Federal Reserve, they've been reducing it by about $60 billion or so a month, as they said. And you can see that it's been on a fairly steady decline for quite a while, really since 2022 began. There is obviously this move right here. This was during the banking collapse back in March of 2023. And back then, there were actually a lot of people that thought that this was QE and that the Fed would not reduce the size of the balance sheet below this level, which was, completely ridiculous. But that was sort of a view back then. But you can see that if the Fed has continued with doing what they said they were going to do. And this is important because it allows us as investors to get insight into whether higher risk assets will outperform lower risk assets. And so as long as this is going down, right, as long as it's going down, then the expectation is that Bitcoin dominance goes up. And again, last cycle, we saw dominance top when the Fed started to expand the size of their balance sheet. Okay? Pretty clearly, that's what we saw. So yes, dominance has taken a hit in the short term. I'll talk more about it later. But I do think it's going to be temporary. I think all Bitcoin pairs will roll over here probably within a couple of weeks or so. And then we'll go to, and then those will go down. Again, we'll talk about that a little bit later. So that is something that has happened today, which is something different because for a long time it's just been we're going to maintain the pace at 60 billion a month, and we're going to keep interest rates at 5.5%. Now it's keep them at 5.5%, but we're going to start tapering the quantitative tightening process, which could mean, unfortunately, that it just drags out even longer, right? Because this whole process is actually, the 60 billion or so, I think they probably could have gone a bit faster, but, it's not really that important. I think doing something like this could just drag it out. They're saying they're doing it to sort of facilitate a smooth transition. I'm trying to find the exact quote that he said. Let me see if I can find it over here. Slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress. Okay, so the reason they're doing this is because they are essentially trying to prevent a hard landing. And we know that hard landings are hard to prevent. In fact, sort of the base case is that you get a hard landing because that's what happens 90% of the time. Don't quote me on that percentage, but again, statistics are made up anyways, but for the most part, 80-90% of the time, you get a hard landing. And the reason is because it's difficult to engineer policy in a way that you start softening up before it shows up in the data. And he said something today that I think spooked the markets a little bit. Some of the other things he said was the labor market remains relatively tight, but supply and demand conditions have come into better balance. Labor demand still exceeds the supply of available workers. You might understand, what does he mean by that? What does he mean by labor demand still exceeds the supply of available workers? It doesn't feel like that, right? But he mentioned job openings. He mentioned all this stuff. So what you can do actually over here on the workbench on the end of the Cryptoverse website, I actually just saved it, but this chart shows job openings per unemployed worker. And it's currently at 1.32. Meaning there's 1.32 job openings per unemployed worker. Now, you're probably sitting there thinking those aren't real job openings, or it's just, whatever. I've never really found any benefit into thinking like that. I just, I'd stick with the data. But I think one of the reasons why, risk assets have done so well for a long time is because while this has been trending down, you still see it above 1. If you look at the recessions during the dot-com crash and the 2008 financial crisis, you had less than 1 job opening per unemployed worker. While this has been going down, it also shows you just how much excess there was. At the peak of this metric, there were 2 job openings per unemployed worker. That is why inflation was so high, because it was so hard to find workers. There were so many job openings, and it was difficult to find people to work for you. And it was very much an employees market. It's transitioning away from an employees market. I think right now it's kind of somewhere in between, but it could go into an employer's market eventually if the Fed continues on this path, where sort of the employer has sort of the advantage. I feel like back in early 2022, the company was having to convince the worker why they should go work for them rather than the worker convincing the company. But I think that's slowly starting to change. So you can look at this chart and see when he says something like this, when he says labor demand still exceeds the supply of available workers, this is what he's talking about, right? There's still all these job openings, but there's not enough workers to fill them. So that's what he means. But it is coming into better balance, right? It is coming closer to 1. And this is good and all as long as it's a slow drop. What happens if you get a big drop? Like what happens if it just drops 1 month from 1.3 to 1 or something, right? That's when you kind of have an issue, because at that point, while the Fed might pivot, it's too late, And I've sort of read a lot about prior business cycles, and one of the sort of the telltale signs is if they wait until they get a bad print in the labor market, it's already too late. So what they really should do is try to pivot before that time. That's easier said than done, because we also know that they don't have a crystal ball. We don't have a crystal ball. We can sit over here, armchair economists, and pretend like we know what's best for the economy. But the reality is there is a risk, right? There is a risk that they pivot too soon. We'll just get a second wave of inflation like we got in the 1970s. There's a risk if they pivot too late, we're going to get a deflationary crash like we got in the 1940s, both 40s and 70s periods of high inflation. So it's hard to know, because monetary policy, as always, right, it operates with long and variable legs. So, the policy that was set in place a year ago might only be just now affecting the economy. And the policy, rates today and QT of today will only affect the economy, let's say, 6 to 12 months from now. So that's kind of the hard part, right? That's kind of the hard part with all this, is you don't really know when to pivot. And it's, theoretically it would be a guessing game to even achieve a soft landing, because you have to know when to pivot before the bad data comes in. If you wait for that, it's too late. At this point, it's not technically too late. I mean, there still is some excess. You could make the case that if they were to pivot now, there's a chance that a soft landing could be achieved, right? But again, they haven't pivoted yet. They are going to taper QT to try to ease the transition, but they're still keeping interest rates high. And right now, the market isn't even expecting a rate cut until, this shows November, but really it's still September, because while this is while it's shaded over here that it's this is the most likely option, that's just the most individual likely option. If you add up the probabilities of all these, there still is a greater chance of a cut in September than a hike. I think there's a chance they could cut this summer. I know that goes against everything that is being said, but remember, in 2022, when everyone was saying there's no way they're going to go 5.5%, that was my target, right? I said 5 to 5.5%, and then it became clear in 2023 to me that they were going to go to 5.5%, even though people said that there's no way they could do it because it would just break something, right? Well, they've gone to 5.5%, and they've been there for 10 months. And back then, everyone just kept asking them, when are they going to cut, right? When are they going to cut? Now, which was such a weird question, right? Like, they're not cutting. I mean, they had to raise rates to combat inflation. They had to get the interest rates above inflation, right? If you go look at interest rates and you overlay inflation onto the chart, historically, you need to get rates above the inflation level to bring inflation down in the first place. So there's never really a question of, are they going to raise rates or not? They were always going to raise rates, and they were always going to raise them above 3.5% because inflation was much higher than 3.5%. So today, it's almost like we have the opposite problem. I feel like 4 people today during the press conference asked Powell if they're going to hike again. And he just kept saying, no, they're not going to hike. They're not going to hike. They didn't believe him. They just kept on asking him, well, what if this hypothetical scenario played out? What would it take for you to hike again? And I mean, he tried to play ball with them a little bit, but he also reiterated they're probably not going to hike. And I don't think they're going to hike. I think they are above R star, the neutral rate. I just think they have to stay here for a sufficiently long period of time to actually have an effect. It's not just the rate, it's the amount of time you stay at that rate. So I don't think they're going to hike again. Not until the next business cycle. I think they have hit the terminal rate. But last year, when all these reporters were asking about rate cuts, it was like, what are you guys asking about? Like, this is ridiculous. Ask about something else. Now they're all asking about rate hikes. they're asking the wrong questions, I think. I think they're asking the wrong questions. A rate cut is much more likely going to come this year than a rate hike. And you might wonder why I say that. Powell did say, we are also prepared to respond to an unexpected weakening in the labor market. Now, I've talked a little bit about this before because what is quote unquote unexpected, right? What does that even mean? And he even said, I'm not going to define that. But he did say what it's not, which I think caught the markets by a little bit by surprise. And I don't know if he means it. He's meant everything he's said so far, so I don't really necessarily have any reason to doubt him. But if it coincides with something else, then maybe they would actually cut. But what I'm talking about is this. If you go look at the unemployment rate, right? If you go look at the unemployment rate, last year we saw a pretty interesting trend, okay? And we're going to get unemployment rate data this week in a couple of days, okay? So let's see where that comes in. If you look last year, you can see a local top in February at 3.6. This year, you see a local top in February at 3.9. Then in March of 2023, it dropped down 0.1 to 3.5, right? So 3.6 to 3.5. Here, it was 3.9 to 3.8. Okay, you see the pattern, right? It's somewhat seasonal here, it seems. And then the next data point in April, it's May right now, but we're about to get the April data point, right? In April, so we got the data point in May, but in April, it dropped again, right? So what happens if it drops again or stays flat? Then you really could have a situation where all these rate cuts just keep getting priced out because the market just thinks, well, hell, how are they going to cut if the unemployment rate's going down? This is the issue. Like, interest rates are at levels and quantitative tightening has continued for so long that it is starting to seemingly affect these risk assets, but it's not slowing the economy in a way that the Fed can say, all right, look, we have to pivot. If you look at it at Atlanta GDP forecast, I think it's like 3.9% or something ridiculous for Q2. Now, it'll probably come down, but the economy has not slowed down. Now, some companies, we saw Starbucks report earnings, and they sold off like 15% because of weaker sales and traffic. We saw DoorDash report earnings, and they just sold off like 15%. I guess no one wants lattes and $100 delivery, but you're starting to see some of these things that, like if you think about like Starbucks, you think about DoorDash, those are things that people could theoretically do without. Now, I'm not a coffee drinker, so if you're a coffee drinker, I apologize. But theoretically, like if you're trying to save money, you're going to cut some of those things, theoretically, because I don't think those people are going to cut their crypto spending, let's be real. So that's what you're likely going to cut. Those things that, they're nice, but you don't actually need them, right? You can just go get your food or you can cook at home. So there's some companies that are starting to show weakness and some of them are still doing okay. But what was interesting about this trend is that while it still went down in April, and we're about to get the April data point, once we got the May data point, we got it in June, it jumped 0.3 from 3.4 to 3.7. Okay? Now, again, I don't know where it's going to come in a couple days. But I'll do a video on it when it does. I have no idea where it's going to come in. I don't even know where consensus is on it. But I'm saying, if it comes in at 3.7 and it goes down, I have to imagine the long end of the yield curve might spike again. But the issue is that what happens if you get the next data point a month from now and it spikes 0.3 from a potential 3.7? Then you're up to 4%. Or what if it stays at 3.8 and then spikes to 4.1%? Or maybe it goes to 3.9 and then goes to 4.2% next month. So there's a lot of different outcomes, but that I think is a risk. And I've talked about this before because I think that the pricing of rate cuts is going to change when the unemployment rate hits 4%. And it's only a matter of time before it does. Normally when the unemployment rate gets moving, it doesn't stop. Right? It keeps going. It doesn't even move in a linear fashion, right? I mean, it starts off slow. We pull up the unemployment rate. It starts off slow But if you overlay, you know, I don't want to do that one. Let's take this one. If we overlay, say, a 24-month moving average, once it gets above this level, it just kind of keeps going up, you know? And so it seems like it's only a matter of time before we hit 4%. Now, I think when we hit 4%, the markets are going to start to open their eyes to, okay, the Fed's probably going to pivot. That's been my base case. But Powell did say something today that I think the markets didn't like. And actually, they round tripped right after he said it, I believe. I was watching the video on a slight delay, so I'm not 100% sure. But what he said was this. He said, the signal that we are the signal that we are taking is that it's likely going to take longer for us to gain confidence. That's not what he said. Well, he said that, but that's not what I was looking for. It would have to be meaningful and get our attention and lead us to think the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, is what he said. So that he's sort of saying that, like, if it moves up a couple of tenths to 4%, they're not going to react to it. Well, that could be a problem for the market, right? I mean, if the market sees the labor market is starting to show weakness and the Fed doesn't care, then the market might make the Fed care. You know, because I mean, again, like once it gets moving, it really gets moving. And so far, it hasn't really moved. I mean, it's been slowly going up. But this is really similar. I mean, look at all these other processes, how long it takes. I mean, like, look at it last cycle, right here. You know, once it hit this low, it took about 10 months to get above the 24-month SMA. It consolidated for, I mean, it slowly went up, but it didn't really start its parabolic move until about 16, 17 months later. If you look here, after it hit its low, it took about 6 months to get above that 24-month SMA. If you take it from really where it started to just consolidate, maybe right here, about 12 months or so, you know, we're currently in about our 20th month. If you take it from the low, we're currently about 15 months out. So, I mean, again, like it seems like if the unemployment rate hits 4% and they don't give the markets a pity cut, the markets might scream at them until they do. So, he did say that they're going to, it's not just that, if they sort of see it more broadly, right? I mean, if they see the unemployment rate coming in at 4% and they're also looking at you know, hires and openings and they're just plummeting, then maybe they would cut. But that's just something to think about, you know, that he said. I also think, you know, everyone keeps asking, I'm like, well, are they going to shift their target to 3%? I don't know how many times he's going to say 2%, but I mean, I think their target is 2% over time. They're not going to get there immediately, but that is ultimately the target. 3% is honestly not great. I mean, you guys see how expensive everything has gotten. And I mean, there's just a lot of things that make it a lot more difficult. So what am I looking for? So let's go back to interest rates. So that's where we are. You know, they're still at 5.5%. They're going to taper quantitative tightening starting in June. So what does that mean? Well, it theoretically means that their ultimate level that they're going to go to is just going to take longer for us to get there. Which means that, yeah, we might be kicking the can down the road on theoretically when Bitcoin dominance tops. Now, a lot of people have sort of asked me about this, so I'm not going to like not talk about it. There's this reality that in the last couple of days, dominance, not last couple of days, last couple of weeks, dominance has taken a big hit, right? And the usual suspects on Twitter are out saying their usual playbooks about it, even though they've been incorrectly calling the top on it for the last 2 years. But what I will say is this. We saw this exact same move before rate cuts last cycle. The exact same move. Precisely, in fact. And it's actually better observed on a dominance chart, excluding stables. Okay? And I can't stress enough that this is something I saw play out in vivid detail last cycle. I mean, like it scarred me. Okay, so again, is there a guarantee it's going to play out? No, there's not. Okay, just because it happened last cycle does not mean it's going to happen this cycle. But I think it's more likely than not going to happen. I think the odds of it happening are probably a lot higher than the odds of it not happening. And while I know a lot of people out there are shilling you alt season for the 30th time over the last 2 years, I even saw alt season trending on Twitter again. This is the exact same move. This area over here preceded rate cut. So the first rate cut in 2019 occurred in July. So it occurred about right here. Okay? Now, look at what dominance did excluding stables. It set a high in September. Okay? And then a little over half a year later, it swept the high, right? After a series of lower highs. After a series of lower highs, it swept the high. Does that not sound familiar? How many people were so confident that the dominance of Bitcoin had topped at the spot ETF? They were looking at these types of charts and saying, well, you know, dominance excluding stables has just been putting in lower highs since October. Right? Lower highs since October. Everyone was saying it. That's why they thought they were right about Bitcoin dominance and everything. And because they were looking at this and like, well, it's putting in lower highs. So what's been smoking over here to say dominance is going to go higher? It was the same move. You sweep the high, and then you get one final pullback. You see that? One final pullback below this resistance up here. One final pullback. How many days did this take? From May 13th, and it bottomed June 6th. Coincidentally, dominance topped this time locally April 13th, right? May 13th here in 2019. Now look over here. Same thing. Lower highs sweep the high. When did it sweep the high? April 13th. April 13th. And so, again, if you look back over here, it formed a low on June 6th. Okay? Now, what if it forms a low on, I don't know, May 6th or anytime between now and then? May 6th, I believe, is Monday, right? 2nd, 3rd is going to be Friday. Yeah, so 6th is Monday. So maybe Monday, you start to see the dominance of Bitcoin turn back around. But what you'll notice is that after it swept the high on May 13th, it came down and was back at that high about 5 weeks later, just before the first rate cut. Okay, about 5 weeks later. Now, could it take longer this time to see it play out? It's possible, but I would argue it might even take shorter to play out because from here, from September to May, was a longer period than October to April, right? That's about 2 months less. So if that was less, then maybe this part won't take as long. But you can see it, right? I mean, you can see it. It swept the high, got a pullback, making everyone think that it was alt season again. And then Bitcoin ripped those altcoins a new one. One last time before dominance topped out as rate cuts and quantitative tightening ended. That move there is the most brutal move. Why is it the most brutal move? Well, the moves so far have kind of been a cakewalk if you think about it, right? The reason they've been a cakewalk is because all Bitcoin pairs have gone down, but they mostly did it while Bitcoin USD went up. So if you're back holding these altcoins while you're watching them mostly bleed to Bitcoin, at least your participation trophy is that, hey, well, I mean, at least it went up against the US dollar, right? Maybe it only went up 20% or 40%. Even though Bitcoin went up 300%, at least you can pat yourself on the back because it at least went up. Maybe the money supply went up more, but you can at least pat yourself on the back. The hard part about that last phase is that's when dominance goes up while Bitcoin goes down. And again, there's no guarantee that that's what happens next, but I will tell you, if that happens, it is the most brutal part of the cycle, where Bitcoin goes down and alts go down quicker. So that, I think, in my mind, is the most likely outcome going into the summer. We're already seeing the social risk plummet, right? I mean, it's back. I mean, look where it is. No one cares. No one's here. I mean, it's just no one cares right now. And so if you don't have people here bidding up alts, then they just bleed to Bitcoin. That doesn't mean you can't get a day where they go up, like today, right? I mean, you have an example of today where they did go up. But the reality, right? The reality of this whole situation is that they're still below their bull market support band. So while it was an impressive move, they haven't even made it to the 21-week EMA. I mean, just a few weeks ago, alt Bitcoin pairs were at 0.46. Now everyone's excited and calling alt season now that they're at 0.44. It's just, I think all these crypto investors, a lot of them are just so used to these short-term moves. They don't remind themselves that just a month and a half ago, alt Bitcoin pairs were at 0.48. Just a couple of months ago, they were 10% higher than where they are now. This, I think, is the final move before they drop. Now, again, with them slowing QT, does it take a little longer? I don't know. But I will say this. When you look at last cycle, we did the same exact thing going into the summer. We got a bounce in May, right? Look at this. You see that? We got a bounce in May. Here, the bounce started in April. And it went up, and it was rejected. It didn't even make it there, but it was rejected by the bull market support band. And then the final capitulation process began. And that is where the dominance, excluding stablecoins, if you go back over to that chart I was talking about earlier, that's where the dominance, excluding stables, got that higher low, right? It put in a higher low. And it dropped from like 60.5% down to 55.5% or so. I mean, give or take, right? I mean, or 61% down to 55.5. So about a 5.5% there. If you look at what's happened today, it's dropped from 59, and I mean we need to see an update on this day, but it was at 56. My guess is it's still around 56 or so. But this is the issue, is that I think you're likely going to see it find some form of a higher low that it builds off of. And if you look at dominance excluding stables in TradingView, you can see that it's still above its bull market support band, right? It's still above it. And if you look at Bitcoin dominance including stables, right? If you look at it including stables, and we look at it on a lower time frame, we just kind of look at what's been going on here with dominance including stables ever since this entire thing began. What's the big deal, right? I mean, it's so what? It pulled back to the trend line again. The trend line that every time it pulls back to, everyone says it's going to break, and then it just keeps on going up. What's the big deal? Doesn't look like an issue to me. Okay, so I think you're likely going to see dominance bottom out soon. It could go as low as the bull market support band. It's not really my base case, but it could. If it does, I think that it'll just be a fake out below this trend line, and then you get right back above it. But I think it's going to keep on going up. Look at these three candles right here, 1, 2, 3, and then after these three in a row, look at that next candle. Dominance just went right back up to the highs in a single week. So remember, when dominance moves, it moves very, very quickly. And I get it. I mean, I know the pitchforks are out right now because dominance is below 54%. But just remember one thing, guys. There have not been that many people that have been as vocal about Bitcoin dominance, as far as I can tell, that I have. I mean, a lot of them have been calling the top the entire way. If you look at monthly Bitcoin dominance Heikin-Ashi candles, this is 18 months in a row, consecutive. 18 consecutive months where dominance monthly Heikin-Ashi candles are green. So, yes, people are giving me a hard time about dominance dropping. Every time it drops 1%, it seems like crypto Twitter wants me to answer for it, just like they have every other month. But this is the trend. I don't think it makes sense to fade the trend until monetary policy has actually changed. You could argue that, with them slowing the pace of QT, does that mean that there's something different going to happen with all Bitcoin pairs? Maybe it just makes the process even slower. And rather than dominance topping out this summer, maybe it tops out. Well, technically it would be summer if it topped out in September, right? Technically speaking, summer goes through September 21st. And actually September is often a time when the dominance turns around. So I don't know. I mean, I do think it could just slow the amount of time that it takes, right? Rather than us getting there immediately to 60%, maybe we just kind of drag our feet and we go up to 58 and then drop down to 56 and then back up to 59. Maybe it's just a slower process to get there. Or maybe we just go right there and then the Fed pivots in summer when no one thinks they're going to. So yes, it's easy to look at dominance on days like today and say whatever, but I don't think the dominance rally is over. And I think that what you're witnessing right now on alt Bitcoin pairs are the final exit pump of them. And investors are using this QT stuff, the tapering of QT, to sort of send those alts a little bit higher on their Bitcoin pairs, kind of like you saw over here, but it still resulted in a lower high. And then we still eventually broke support and we went all the way down to the range low. Altcoins are oscillators at best, right? That's just the reality. You can say your altcoin is great and all, but the reality is that they're oscillators against Bitcoin at best over a long enough period of time. If you only look over one cycle, you can obviously make another case, or some of them you have to look over more than 2 cycles. But usually they do become oscillators at best over a long enough period of time, and usually a lot of them just end up bleeding. So if individual alts are oscillators at best, then the collective altcoin market is an oscillator at best, right? And if that's the case, then it just simply means that all Bitcoin pairs have to drop. They don't have to drop, but theoretically they should drop about 40% or so to get you down to the range lows. And I saw it happen last cycle before rate cuts. And, that's why I've been so pessimistic about alt Bitcoin pairs for the last 2.5 years, is because I saw this happen, right? That process from here to here took 3 years, I don't know where you want to measure this from. If you measure it from this top, right, like early 2022, if you measure this one was early 2018. So if you measure it from early 2022, we're out 121 weeks, right? 157 weeks puts you all the way out actually at the end of the year, which is kind of funny because, again, when did alt season actually occur last time? It was in the post-halving year. Right? Dominance goes down for dominance goes up for 3 years. Alt Bitcoin pairs bleed for 3 years. And then finally you get alt season, right? Alt season that everyone talks about is like, it just lasts a few weeks or a few months every single cycle. Okay? It's this move. It's really quick. People make a lot of money. And then they spend the next 3 years dreaming about it. But I don't think you're going to get that move until we go down here. So I think we need to spend at least the rest of the summer, and we don't have to go down for the rest of the year, but we could go down and then bounce around these lows and then go up in the post-halving year. But I just don't think you're going to see this alt season that you want until alt Bitcoin pairs are down here, once they're a shell of their former selves. And I don't think they're there yet. I don't. I think that dominance needs to go higher. It just, I don't think the animal spirits have been broken yet. And I think that's, look no further than ETH Bitcoin. I mean, it's still doing what it does. And as I said before, I think it's going to be rejected by the bull market support band or below it. And so far it has. We'll see if that prediction holds water or not. And if it does get above it, I think it would be short-lived, like these examples right here. But I don't really even think it's going to get above it. I think it's, potentially this same move here, right? These two tops, and then this was your third one. Then you have these two tops, and this was your third one, where maybe you wick above it, but I just generally think it's going to slowly bleed back down. And again, this is the same area as this, which is the same area as all Bitcoin pairs doing this, which is what I think they're doing right now, which is the same area as dominance excluding stables, getting this last pullback before shooting up to the final levels. Okay, so I'm not backing down on Bitcoin dominance right now. I know a lot of people want me to, but I'm not. I do think it is going higher. I think the target for me is 60%, and I think that it could do so in a way that where all USD pairs are also going down, not just all Bitcoin pairs, but all USD pairs are going down with it. So just keep this in mind. I could be wrong about it, and if I am, I'll have to live with that, right? But I experienced this last cycle, and I was hoping that maybe I could help some of you guys not back hold altcoins 95% all the way down against Bitcoin for the last 2.5 years. So if you've been on the Bitcoin dominance journey with me, thank you. I mean, it's the dominance journey, I think, is closer to being over than beginning, obviously. I mean, I think it'll be over this year, but it has been a long journey, and I think we're almost there. But I still think that dominance excluding stables is going to get that final move up into the summer months, and I just think that dominance will ultimately go to 60%. And so those are my views, and those are my views on the FOMC and all that comes with that, and inflation. Inflation has been sticky. I kind of want to talk about all the job stuff, but I'm going to wait for the end of the week, and then we'll do a video on the jobs report. But inflation has been sticky, and this is a problem, is if this just keeps staying sticky, the Fed has to stay higher for longer, rate cuts get priced out, and then businesses capitulate, and then the Fed pivots, right? The Fed doesn't pivot because the market is saying, hey, this is when they're going to pivot. The Fed pivots because you get a bad data point, and they're like, oh crap, we've gone too far, and we need to cut. That's what normally happens. It's not like we're all just going to look at this and, know exactly when rate cuts are going to happen. These probabilities change every single day. I mean, these investors that are supposed to be the smartest investors, I mean, the probabilities of this stuff change constantly, right? Because the markets are changing constantly. But you can't look at this stuff and say definitively that it's going to happen. When we came into this year, the market was pricing in a rate cut in March, right? It's now May, and now the market's not pricing in a rate cut until September, November timeframe. So don't look at this and say that this is what has to happen. It doesn't. It can be very different from what you see here. I don't really think you're going to get a ton of rate cuts this year, but I could see a few rate cuts. You could get more if you get something bad happen, but as long as the market just kind of slows, as long as the economy just is slowing down gradually, then you're probably just, it might only get 2 or 3 cuts. But yeah, those are my views on the market. Hopefully they've been useful, and we will see what happens with the labor market data for the rest of the week, and then I'll do a video on that on Friday. I did make a video on ETH like 2 days ago, and I was going to release it yesterday. Then I was like, oh crap, that's the first of the month. I got to do the Beauty of Mathematics video that day. So I didn't release it. And I was going to release it today. I was like, oh, I can't do it today because I got to release the FOMC. So theoretically, I'll release a video on Ethereum somewhat soon. But when I recorded the video, Bitcoin is at 60K, and now it's at 57K. So I'm like, do I even release it? I mean, it's almost like irrelevant at this point because Bitcoin's $3,000 lower than when I made the video. But I don't really like releasing, multiple videos in a day because a lot of these videos are long, and I don't really expect people to be able to watch more than one video a day anyways. But I will try to get that out at some point, maybe tomorrow, maybe I just end up re-recording it. But if you're watching a video by me on Ethereum in the next day or something, and you're wondering why ETH is a lot higher and why Bitcoin is a lot higher, it's because I recorded it, yesterday or something, or 2 days ago, and I just didn't release it because I keep having to put out these other videos that are, more standard. Like the first of the month, we do the Bitcoin Beauty of Mathematics, FOMC. You got to do that, you can't not do that on the day of the FOMC. So that's where we are. And in the short term, Bitcoin has lost the 100-day. So that's kind of interesting. Like, that didn't really even get a bounce. So not really the best look by Bitcoin. It has fallen near the bull market support band, but it hasn't quite gone below it just yet. My base case is that we will likely eventually go below it in the coming months. It doesn't have to be immediate. We could in fact get a bounce here before we even before we get to it. I mean, we saw bounces even in 2019 where we eventually failed to hold it. We did sometimes wick close to it and then get a bounce the following week. Right? And if you got a bounce like this, then maybe dominance goes up, where Bitcoin goes up and then alt sits still. But yeah, I mean, I would certainly keep an eye on this. There's a good chance we fall below it. It's not set in stone by any stretch of the imagination. I would keep an open mind, but it's been a long time since we tested it. Usually when it goes that long, there's a decent chance you fall below it. So we'll see. We'll see what happens here. But it's already not been able to hold the 100-day SMA. We'll see if it can get back above it. Sometimes you get like a fake out just below it. But it's just that 100-day is going to keep on going up in the short term. So it's going to be harder and harder for Bitcoin to reclaim it. But that's where we are, guys. I think we'll wrap it up there. Thank you guys for tuning in. Check out Into the Cryptoverse Premium. If you want more content, we do Thursday AMAs. So if you want to ask a question, just join Into the Cryptoverse Premium with the Thursday AMA. And there you have it. I'll see you guys next time. Bye.